Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, July 10th, 2024. Hope you're having a fantastical day out there in the interwebs. It is another beautiful day here in Colorado. It's going to be a little warmer than yesterday, and it's going to get real hot this weekend into the 90s. But I hope you're having a fantastical day out there. Hope my friends down in the Houston area are getting their power back on. Talked to a client today who got her power back on, so that's a good thing. And we were able to conduct our meeting as scheduled. So awesome news. Anyways, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All right, let's get into today's numbers and see how they turned out. Dow Jones, wow, big jump today, up 1.09%, 429 points, closed at 39,721. The S&P 500 up 1.01%, 56 points, closed at 5633. NASDAQ up 1.18%, 216 points, closed at 18,645. The VIX was also up today, 2.72%. It's at 1285 right now. So that is a little odd that the VIX jumped and you had such a large jump in the a 1% jump in the S&P. Let's see here. Canada up 1.4%, Brazil up 0.12%, and Mexico up 1.78%. In Europe, Germany was up 0.99%, the UK up 0.2%, France up 0.86%, the Netherlands up 0.96%, Spain up 1.59%, Italy up 1.3%, Switzerland up 0.89%, and Portugal up 1.37%. Russian exchanges both read today. The MOEX down 2.4, the RTSI down 2.24. And the Asian markets overnight, the Nikkei in Japan was up 0.5%, Australia down 0.16%, New Zealand up 1.14%. In China, the Shanghai was down 0.68%, Shenzhen Component down 0.1%, China A50 down 0.51%. DJ Shanghai down 0.61%, Hang Seng down 0.29%, and when the Taiwan weighted last closed on the 9th, it was up 0.09. All right, so that is everything there. So that looks... Let's go ahead and get over to the market recap for today. The S&P 500 in fresh record high after scaling 5,600 mark for the first time. Excuse me. Still got that lingering tickle from back in May on my cruise. All right. The S&P 500 rose above 5,600 for the first time on Wednesday, driven by gains in the tech sector and anticipation of sooner interest rate cuts as the Federal Reserve Chair Jerome Powell continued his testimony before Congress. This milestone comes a day before the release of new inflation data. The tech sector led the market's record performance, with Apple reclaiming its position as the most valuable company, surpassing Microsoft. Apple stock increased by 1%, bolstered by investor optimism over its iPhone sales. Bloomberg reported that Apple aims to ship 10% more new iPhones in 2024 compared to last year, driven by expectations that AI-enabled iPhones will boost demand. Microsoft also rose by 1%, despite plans to relinquish its observer seat on the AI board due to its increasing regulatory scrutiny over generative AI. NVIDIA Corporation added more than 2%, pushing the broader chip and tech sector higher. Federal Reserve Chair Jerome Powell stated that he still sees a path to a soft landing. You believe that, folks? For the U.S. economy, despite the central bank's restrictive monetary policy aimed at reducing inflation. He emphasized the importance of balancing inflation control with labor market conditions. Powell's comments supported traders' expectations for a September rate cut, with the CME Fed Watch tool showing a 72% chance of a 25 basis point cut in that month. Energy stocks also traded higher despite recent warnings from Exxon and BP about lower refining profits. Oil prices rose following data from the Energy Information Administration showing that oil inventories unexpectedly fell by 3.4 million barrels last week against expectations for a 700,000 barrel build. So, I mean, that's kind of a 700 build versus a 3 million barrel draw. Let's see here. Baker Hughes, Chevron, and Phillips 66 were among the biggest gainers in the energy sector. With Powell's dovish hints and expectations for a soft inflation data on Thursday, the market remains optimistic about the potential for rate cuts. The tech sector's strength, combined with positive energy stock movements, continues to drive the market's upward momentum. All right, so that's that. Let's get over to some wholesale inventory data. U.S. wholesale inventories rise in May. All right. U.S. wholesale inventory saw a solid increase of 0.6% in May, matching previous estimates and marking an improvement from the 0.2% rise in April, according to the Commerce Department Census Bureau. Economists had expected these inventories, a significant component of gross domestic product, to remain unchanged. Despite this monthly increase, inventories were down 0.5% on a year-on-year basis in May. For 2 consecutive quarters, private inventory investment has negatively impacted GDP as businesses manage their stocks cautiously while domestic demand stayed strong. However, there is cautious optimism that that inventory accumulation might mitigate some of the anticipated negative effects on GDP from an expanding trade deficit. Growth estimates for the second quarter are projected around 2% annualized rate, up from 1.4% in the first quarter of the year. Wholesale motor vehicle inventories increased by 1.4% in May. When excluding autos, inventories rose by 0.5%, a figure that contributes to GDP calculations. Sales at wholesalers also grew by 0.4% in May, following a 2.2% rise in April. At the current sales pace, it would take wholesalers 1.35 months to clear their shelves, unchanged from April. The steady increase in wholesale inventory suggests a potential positive contribution to economic growth in the second quarter. All right. Next up, got an article here talking about Peter Schiff. Peter Schiff, more doom in the data. So this is a recap of one of his more recent podcasts. So let's see what he had to say. All right. In a recent episode, Peter Schiff recaps concerning economic data and shares his insights on gold, silver, and President Biden's recent interview. He highlights significant downward revisions to job numbers and declining manufacturing sector as troubling indicators for the economy. Friday's job report initially appeared optimistic, showing 206,000 jobs created in June, exceeding the expected 189. However, deeper analysis revealed substantial downward revisions for April and May, reducing the net job gain to just 95,000, with a mere 50,000 in the private sector. Manufacturing job growth was particularly weak, with 0 jobs created in May and 8,000 lost in June. The stagnation in productive jobs contributes to larger trade deficits and inflationary pressures, painting a picture of stagflation. The labor force participation rate remained weak at 62.6%, and the unemployment rate rose to 4.1 from 4 the previous month. Schiff suggests these statistics are still too optimistic, reflecting systemic flaws in government data collection methods that obscure the true state of the economy. He argues that if the economic statistics were measured as they were before 1994, the underlying economic distress would be more apparent. Schiff also discusses gold's performance, noting its price nearing $2,400 per ounce. He predicts that gold mining stocks will soon improve as higher gold prices boost earnings beyond analyst expectations. He sees significant value in gold mining stocks, which he believes remain undervalued and offer substantial investment opportunities. Additionally, Schiff critiques President Biden's recent interview on ABC, where Biden attempted to justify his poor debate performance and accused Donald Trump of lying. Schiff accuses Biden of hypocrisy, accusing that Biden himself has a history of dishonesty. He contends that Biden's long political career has been sustained by lies, making his accusations against Trump particularly disingenuous. Schiff concludes that Biden's presidency is built on falsehoods and diminishing his credibility. Not that I ever thought that Biden had any credibility, but some people out there still think he does. All right, so that's that. And one last article here, just some food for thought. The Great Monetary Pivot of 2024. All right. In the wake of the 2008 financial crisis, the Federal Reserve reduced interest rates to approximately 0 and maintained them there for, till about 2015. Starting in late 2015, the Fed initiated a rate hiking cycle that lasted until the repo market turmoil in late 2019. The onset of the COVID-19 pandemic saw the Fed revert rates back to near 0. This subsequently led to inflation reaching 40-year highs in 2022, prompting one of the steepest rate hikes in history, with rates climbing from 0 to over 5% in just 18 months. Can you believe that? That's just insane. With the soaring interest rate expenses on federal debt, further significant rate hikes seem unlikely. The debt to GDP ratio stands over 120%, much higher than the 30% in the early 80s when rates were raised above 17% to combat inflation. The current high debt load and interest expenses limit the Fed's ability to increase rates without risking the U.S. government's financial stability, or as I like to call it, insolvency. The Fed paused its rate hikes about a year ago and has recently signaled a potential pivot to easing monetary policy. This indicates that the Fed may have effectively conceded its battle against inflation, even though the year-over-year CPI remains around 3.3%, above the Fed's 2% target. Bloomberg refers to this as the great monetary pivot of 2024. Despite historically, gold prices being negatively correlated with real interest rates, gold prices soared to new highs during this rate hike cycle, defying expectations. This suggests that investors doubt the Fed's ability to control inflation, similar to the 1970s scenario. The U.S. government's growing debt is likely to force the Fed into further currency debasement through quantitative easing. This has historically involved creating money out of thin air, significantly increasing the money supply and leading to inflation. Future QE programs are expected to be even larger than those during the COVID-19 pandemic, which saw $120 billion injected monthly. This monetary policy approach could result in continuous currency debasement, leading to a possible collapse of the dollar, which I would not be surprised. This scenario could trigger a severe volatility in financial markets, potentially devastating ordinary people's savings and retirement assets and significantly altering society. The economic crisis that may follow could be unprecedented in scale and impact. There's some positive news, right, folks? Alrighty. Well, that is everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. You can see it right here on the screen. Just type it out, DSAFinancialGroup.com. All right. Well, like I said, that's everything that I had for today. Hope everyone has a wonderful evening, and I shall be back again next time. Adios.